Well, a warm welcome, everyone, and thank you for joining us today. My name's Joel Carty from Solace Financial, and today we have Anthony from Arconic. Arconic is a specialist technology manager for the AI native era. Anthony is one of Australia's leading early stage enterprise technology investors with over 25 years of experience at the intersection of capital markets, technology, and investment leadership. As former head of Westpac Strategic Ventures, he built one of Australia's most active B2B and enterprise early stage investment platforms, delivering top-tier returns and forging landmark partnerships between startups and blue-chip corporations. Anthony has also served on numerous boards in Australia and the international venture sector. Before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your objectives, financial situation, or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Also, please refer to a product disclosure statement regarding the financial product for further information. Details of this general advice warning can also be found at the moneysmart.gov.au website.
Thanks for joining me today, Anthony. As a fund manager specialising in technology for the AI native era, can you talk us through Arconic's history and investment philosophy?
Yeah, thanks, Joel. It's great to be here today, and I guess it's probably important to give a bit of context about who we are and what we focus on, because it will help unpack our philosophy and where we focus and our investment process. So Arconic's an early stage venture capital manager. We have an early stage fund where we're investing in B2B and enterprise founders who are applying or using AI to solve critical problems in different industries and across different business functions. So our focus is to find exceptional local leaders building market-leading, category-leading solutions locally, but that have the potential to expand into global leaders. Think the likes of Atlassian over time. And so at Arconic, we draw on a decade of heritage and experience. We're a specialist manager who's been built for this AI native era, where we operate like the technology companies that we invest in. And so what does that mean? It means ingesting data, screening over 20,000 prospects, and codifying our investment process, our investment framework. And so whilst we draw on this heritage and this process, a lot of different managers in early stage venture have different types of philosophies. And clearly, an investment process in venture is very different to public markets. You'll often hear that a lot of managers are really focused on backing the founder and really taking more of a lens and a focus on finding individual founders who can build something exceptional and scale it globally. And whilst we really do also believe that that's critical, one of the central philosophies that we have is that greatness is the sum of parts. And for us, that means that we're trying to find the right combination of team, execution, product, market scaling, technology, capital structures to build those generational companies. And so how we translate that belief into a process is really, really important. And very simply, there's kind of 5 stages or steps to us going from that objective and what we're trying to find to really sourcing, screening, and being able to make those underlying investments. So I might talk you through some of those phases and give you a bit more color.
Yeah, please expand on the investment process.
Yeah, so one of the first thing we really need to focus on is sourcing and screening those highest potential startups that are aligned to our thesis. And in the traditional world of venture, how that would typically look would be that you build up a brand and a reputation over time and track record. And with that network and different repeat founders, you'd be in a position to be able to have some of them come to you and be able to work through your screening of those prospects. And we still think that's really critical and important, and we draw upon that heritage and experience. But we believe that in this world that's changing rapidly, that actually you need to be in a position where you can draw on a whole range of different data sources and to be able to track almost the 25,000 early stage startups here in Australia. So what we do is we've developed a platform called Lighthouse. It's our proprietary data platform. We've got about 1.5 million data points that we're refreshing quite often. And we draw that information from everything from LinkedIn to IP filings to new company registrations, observable activity like web traffic, app downloads. And the main objective at this point is really to filter and assess those highest potential startups out of a big universe and distill it down into something where we think that we've got a target set that we can go out with and engage early. So we're looking for things like founder background, what's the market that they operate in and the size of that addressable market, what are the competitive dynamics, how it aligns with our thesis, capital intensity, all those different things.
Okay. So as you're going through that screening
Yep.
process, how do you assess risk when you make the investment decision?
Yeah, look, assessing risk is a really, really important part of what we do. And venture is in the business of making calculated risks. All right. So, unlike public markets where the portfolio structure is probably about every single underlying selection generating a target return, venture is about making a series of investments across a range of different companies. And the typical pattern is that, out of, let's say, 20 different companies, generally you would see 2 to 3 really, really succeed over time and generate those outsized returns.
Mhm.
And naturally, by design, some of those early stage companies are riskier and won't necessarily achieve those kind of returns. But we look at some really important things. Sorry, go ahead, Joel.
I was going to say, is that the concept then of letting your winners run and cutting your losses short?
Yeah, I think a little bit differently about that. Yes, that's like directionally, that's a pretty fair point. And I think of it's certainly around portfolio construction. So there is an important part of the approach here where it's about how much capital we're allocating to our initial investment partners, how we're reserving enough capital to be able to actually really support those that we see thriving and emerging. Perhaps one of the differences in our philosophy to maybe some other funds is that I've seen a lot of the portfolio companies that we've backed over time that sometimes it's just the right sequence of time allowed to pivot on different products, the right sequence of market events. And so, you do want to be in a position as a investment manager where you are still supporting all of your portfolio partners through their growth cycle. But yes, you need to be very, very considerate in how you're allocating that capital. But really, at this point, when we're thinking about risk, there's a whole bunch of things that we look at. Some of the most important are clearly, founder market fit. Do they have the kind of earned background to be an expert in what they're doing, that depth of experience, team execution capability? Have they got the right people around them? Because often you're investing in a belief in that team and they can be the ones to execute and become the leader in building a critical product in market. Demonstration of some traction versus just kind of, let's call it vanity metrics. You want to be able to see they're actually getting adoption with clients. They're getting kind of engagement scores high. That means, understanding and getting references from clients. And other things that are really quite rational, which can be harder to predict at an earlier stage, but ultimately you still want to see that the business can produce unit economics that are positive. And whilst they're going to be funding to grow and win a market, that they can get to profitability over time.
Okay.
And in this environment, just to round that out, one of the things that is more important than ever is with the advent of AI, there is certainly a different archetype and model. And one of the things that's really important now is that we are looking for some kind of defensibility where a startup has some kind of unique technology, unique data set, unique integration, distribution relationships, which mean that they aren't necessarily going to be easily overrun by some of the foundational models that are looking to build into different industry verticals.
So that then leads into my next question. What are the
Mm.
opportunities and risks you see at the moment?
Look, everyone's obviously inundated right now with talk of AI and what that means. And that can probably be a little bit frustrating because you hear a lot of generalizations. There's obviously massive capital deployment. There's a lot of big claims. And ultimately the question is, where's the big impact? We fundamentally believe that we are at the beginning of a regime change. We see the potential for the application of AI and more specifically agents within the business segment and enterprises, where they will reshape how different functions in organizations operate, whether that's HR and payroll, whether that's finance, or how different industries and very specific use cases in different industries emerge, whether that's in resources, energy, banking, credit management. And so we believe that we're at the stage of a cycle where, like other cycles that we've seen over time, we're at the first percentage point. Yes, there's a lot of promise. There will probably be some ups and downs through this stage of the cycle, but we do believe that over the medium term, the opportunity is significant. And if you just look at the Australian market, we've got about $6 trillion in incumbent market cap at risk, like companies that are sitting on the ASX that have a significant amount of value, whether that's in resources, banking, logistics, healthcare. And, some of these companies are going to be embracing AI solutions, some will struggle to. And so the opportunity that we see is that there will be some amazing market leaders here in Australia who can build into those sectors, who can solve very specific problems. They can have an edge locally, and they can have potential longer term to become global generational companies. And those are really the kind of businesses and the opportunities that we're looking for.
Okay. So what would you say is Arconic's greatest strength as a fund manager, especially in the space that you're working in?
Yeah, I think it's it's a really interesting thing when you unpack it. And the way I think about it is two different ways. The first thing is, before you even talk about an edge, you almost need to have earned the right to be in a position where you're looking for and partnering with not only investors, but some of the best emerging companies in the market. And what that comes from, Joel, is heritage and experience. So, being in a position where over a 10-year cycle, you've invested across a broad range of technology sectors, software, cybersecurity, enterprise, fintech, and AI, that's really important. But it's actually the experience that you get through a whole range of different events, whether that's stress scenarios, follow-on investments, offshore expansions, product pivots. And so I think that's just a baseline. A lot of people can look at a pitch deck and probably say, I like the look of this company, but a lot of the real value over time actually comes from what happens post-investment and how you're actually leaning in and supporting those companies. So that's the baseline. But the real strength that Arconic brings is, we're in this world which is increasingly going to change. Startup models are changing, the technology stack is converging, the type of founder is changing. And so those traditional brand networks and patterns in venture are actually becoming less reliable. And so that's why we've architected Arconic with platforms like Lighthouse that help us ingest this data and use systems and rules to augment our experience. So things that give us an investment insight, tools that allow us to operate more efficiently through a diligence process, codifying all the criteria that we think are really important to identifying and scaling those investments. And as data becomes more prevalent in the market, even with private companies, we think being in that position where we can see more, move faster, and make better investment decisions with that data framework is a really, really important edge. And the second thing I'd call out, Joel, just sorry, but you might be jumping. The second thing I'd call out is there are a lot of funds in the market, and there's a lot of great investors, and there's a lot of capital. And I know from my experience with great B2B and enterprise startups that sometimes more than capital, what they want is experience and impact at the top line. And over the last 10 years, as I've worked with some exceptional founders, we've spent more time executing high growth partnerships between ventures and corporates than most in the market, whether that's Shopback or Rich Data Corp or MX51, and being in a position where you can help early stage companies understand what it means to engage with those enterprise clients, how to open those doors, how to define the solutions for them, how to work through vendor assessments and diligence and commercial structuring, I think is going to be increasingly important in the next 10 years. So that's a really critical edge and point of difference for us.
So it sounds like you're not just investing in the company monetarily wise, you're actually getting in there and helping them make decisions and network and make business deals.
Yeah, look, I mean, it's probably one of the most important roles as a venture manager is the job that you have and the partnership that you have once you've invested. And it goes back to that question of risk and different points in the cycle. That can manifest itself through the obvious, which is participation in the board and helping with decisions. But, certainly over the last decade, in my experience, you are partners with these founders and you're advising them in extreme situations. You're giving them, kind of technical input on things like employee incentives or offshore expansion plans. So that is the role. That's
Okay.
really a significant part of what we're here to do.
Well, can you talk us through a time when you've turned a period of poor returns with one of your investments
Yeah.
and turned the opportunity around and made it into something more successful?
Yes, yeah, absolutely. And it's an interesting question. It kind of highlights just how different public markets are to private markets. And as you would know, Joel, in public markets, those poor returns can show up in monthly, quarterly returns. And you can exit positions, you can take different positions. A venture fund, like a private equity fund, is quite different because you're investing over a medium-term period, and poor returns don't manifest themselves in these quarterly marks. Ultimately, they manifest themselves in the situations that these companies are going through, and that kind of J curve of growth. And so there's two ways that we think about this. The first is one of portfolio construction, which is you don't want to be too concentrated in any one company and have everything riding in any one company. And you don't want to be beholden to the market beta of rates changes or valuation metrics. And so having a broad blend of exposures and having the right mix in your portfolio is important. But beyond
Okay.
that, over the last 10 years, there's certainly been times with some portfolio companies where events happen, and it's less about how you can't exit those positions. What you need to be doing, as I said before, is being really, really aligned and advising them in different situations. So for one of our portfolio companies, there was a near terminal event where they were off-boarded by one of their key technology platforms. It meant that they couldn't actually deliver their technical solution. It resulted in scenarios where clients using that service could no longer use that service. It was highly complex. And our role in those situations is to be able to come in, help and support their managed stakeholders, try and find different technical solutions with them, be patient and provide the right support and capital. And so this isn't necessarily about you can't exit positions and change those scenarios, but you need to be able to support them through those challenging times. And the same thing happens with personnel in these companies. We've had portfolio companies where there've been challenging situations between co-founders or co-founders and executive teams, and that goes right to the heart of the performance of these portfolio companies. And so being in a position where you can act rationally, you can have a structured approach to kind of work through some of those issues and sometimes make the hard decisions is really, really important. And so absolutely, over the course of any 5 to 10 year period, when you've got a range of different portfolio companies, there's going to be varying stages of performance. But it is about how you're actually assisting them with all the different growth factors and managing the team, advice and expansion that becomes the differentiator over that performance period.
Okay. Well, what type of investments have you made recently?
Yes, we're actually really excited. Our most recent investment was in a company called Optimize, and you find that when you see this great mix of companies, there are thousands of amazing ideas and companies. Just you learn a lot about different industries, and we've known that in the world of enterprise and business segment that cloud spend is significant. All right, and if you were to try and size it, what you'd find is it's the second largest expense behind headcount. And so about 30% of spend right now goes to supporting infrastructure in the cloud. But about 30% of that is wasted spend. And the reason for that is that the underlying cost base for your cloud expense is made up of millions and millions and millions of individual timestamp line items, this disk, this array, this service. And it makes it very hard for companies and organizations to be able to actually sit down and make smarter and financially sound decisions about how much cloud they're utilizing. And so Optimize's mission is basically to help every enterprise make those smarter decisions to improve profitability and basically have the technical literacy to be able to actually turn off, optimize, and tune their cloud utilization. And so the objective over time is to put the power in the hands of the CFO or the financial controllers, as well as the typical DevOps and technology teams, to be able to actually attribute that complex set of expenses down to products and teams and make those decisions that allow them to optimize their spend. And so if you think about how that aligns with our thesis, well, the size of the addressable market for cloud and cloud optimization is huge. Finding domain experts who've got deep expertise in the segment is critical. Having a technology platform on an edge where they can actually build their own AI-driven proprietary attribution engine is the kind of capability that we look for. And so we think that's a really great example of trying to find companies that have got fantastic local expertise and technical capability, but the potential to be able to scale globally.
Sounds like an exciting space.
Yeah, it is. And the team, Dora and Ralph, are fantastic. So we're really excited. We know that they're at the early stages engaging across a whole range of commercial and enterprise customers. And we certainly know from our engagement with them that the opportunity's there. So we're looking forward to working closely with them.
Now, you mentioned Lighthouse platform a couple of times as we've
Yes.
gone through this conversation.
Yeah.
How does that stay up to date with changes in the financial markets? And then how do you stay up to date with information on Lighthouse?
Yeah. So again, it's an interesting distinction between what would be your typical financial markets where there's, daily moves and changes, whether it's kind of individual company events or macro events versus the information that we're looking for on these private companies. And so I'll kind of unpack that differently. So Lighthouse will draw down information about individual private companies from a whole range of sources. As I said, we can scrape information from LinkedIn. We can go to publicly available points where we can see momentum like downloads or kind of feedback cycles from developers. And so that's how we're actually ingesting data to be able to actually track momentum, enrich information about the factors that are important to us. But public markets and financial markets more generally are still very important to us in being able to see where the world's going, understand where the kind of public market technology leaders are heading and operating. And certainly the impact of interest rates and valuations for those public companies have a direct bearing on how we think about our portfolio companies. So we have obviously, I've talked about Lighthouse, where we're scraping and using a whole range of information from X and from LLMs and public market sources. For me personally and for the team, I grew up in financial markets. I worked at Macquarie Bank for a decade. And so, it's everything from being awake at 2 a.m., watching CNBC and seeing what's happening, through to having a very diverse source of financial and technology content producers on X. We have a lot of direct market intelligence. So we're engaging with a whole range of other investors, with institutions, with investment specialists. We're getting founder feedback on the financing environment, and even conversations with our LPs and our investors is really helpful to how we think about portfolio construction and allocation design. And so really our job is ingest as much as we can, understand what's noise and what's relevant, and try and use that to distill down decisions around where we're investing, but also what we're doing as we're managing our portfolio companies over that cycle.
Okay. What makes a good portfolio manager?
Well, again, like a portfolio manager in a private equity or a venture fund is quite different to a portfolio manager who's sitting there perhaps making day-to-day decisions around individual stocks they're moving in and out of. But I would put it down to 4 parts. So the first is you need to have the depth of experience across technology and different business segments to be able to see what a company is doing and the potential and where it can go. Because more often than not, these are very early stage companies, and sometimes it's about being able to kind of pattern match and have previous versions of what you've seen as success to be able to make those judgment calls. The second thing is there's a very important art in doing these deals and investing with, high growth founders or companies and their boards. And it's about nailing alignment on terms without feeling like you're destroying a relationship or divorcing. And there's always great tension in any commercial deal or investment, but venture is as much about information and data as it is about long-term relationship building. So you need to have the ability to build relationships, work closely. Yes, of course, deal with difficult situations, but build that trust over the longer term. The third is bringing real value. We talk a lot about backing the founder in venture, but that means advice on capital, advice on people and teams and compensation, helping and provide direction through the board and strategic decisions, bringing commercial deals, doing all the things that can really add value. And finally, from my perspective, Joel, what I've seen over the last decade, certainly in investing in high growth companies in B2B and venture, is there is some real value as a portfolio manager in being able to bring complex players together. So that's like large enterprise clients who, if you win them, can be transformational to these early stage businesses. And yes, these early stage businesses. And so, that large elephant hunting, finding corporate partners, being able to understand the dynamics on both sides and trying to bring them together ultimately to execute partnerships and deals, I think is a really important and big distinction beyond just being an investor and observing from the sidelines.
Okay. Well, Anthony, we've covered a lot of ground in this conversation. Is there anything else you'd like to add?
No, look, I mean, all I would say is that certainly from Arconic's perspective, we feel like the next 5 years is going to be a really amazing and exciting time, and we're confident of the position that we're in with the platforms, the data, and the framework that we're building right now. That we've got a great opportunity to go out there and find those next generation of leaders in the market. So it's a really exciting time. We're looking forward to it.
Definitely. Well, Anthony, I appreciate you making the time to talk with us today.
No problem, Joel. Great. I really enjoyed it. I hope the audience enjoyed as well.
Thank you.
If you'd like to talk with Solace Financial regarding your current financial strategy and whether it's suitable for your goals and objectives, please reach out and contact me via our website or give our office a call to schedule an appointment. Thanks again for your time, Anthony.